RP Crest was founded in 2011. Our business model is to be an insurance company for capital market risk. Our return sources are volatility risk premiums. But what is a volatility risk premium? It is an asset class that you earn by spreading a short position in implied volatility versus a long position in realized volatility. Sounds complicated, but it's actually quite simple. How this is done, I will show you now. I am Matthias van Randenburg, founder and CEO of RP Crest. Before we start, a brief note. The following film has 3 parts. Part 1 is a case study about volatility risk premiums. In Part 2, we analyze the evolution of volatility risk premiums during the worst thinkable environment for this asset class, namely the Lehman crisis of 2008. Based on this analysis, we outlined characteristics of volatility risk premiums. In Part 3, I address the particular challenges of this asset class and explain why only in rare circumstances you should entrust your funds to a short vol manager. Here you see the long-term performance of the Euro Stoxx 50 and of its volatility risk premium. This nice and steady performance was produced by selling 1 month straddles on the Euro Stoxx 50 and then neutralizing all delta risks through an opposite futures position on a daily basis. Sounds complicated, but it's not. I will show you how it's done on a step-by-step basis for the months of June 2003. The month of June was a period during which the arbitrage pricing relationships of options materialized almost perfectly. As such, a perfect month for the following illustration. At the beginning of the month, we sell a straddle, call and put, both striked at the money and with 1 month's maturity. The market is trading at 2,330, so we will strike the options at 2,325. By selling the options, we realize premium income, the level of which will depend upon the prevailing implied volatility level. In our case, volatility is trading at 26% and we receive 141 euros in premium. However, rather than the premium income we collect, it is important to understand the risks we assume by selling the options. This is precisely shown to the right. The delta of the call is negative, it's making us short the market. The put delta is positive, it's making us long the market. Both together net up to a 5% short position. But we do not want to carry any delta risk and must therefore hedge this 5% short position by buying futures. We buy 5 futures contracts and make a record of the transaction in the shown trade plotter. We see the date, what we did, in what quantity, and at which price. Okay, let's move on and look at our position overview, where we see the delta risks that we have in our futures portfolio and in our options portfolio. As you can see, they are both netting each other out. That means, overnight, we were actually carrying 0 delta risk. Let the next day start. The market is going up. This move makes the calls go into the money. Their delta increases, they are making us shorter. The puts, in contrast, are going out of the money. Their long delta is decreasing so that our straddle position is now making us much shorter than before. On total, we are now 28% short. This means we need to buy futures again, a total of 23 contracts, so that the overnight delta of our portfolio is again hedged to 0. We again make a record of the trade in our trade plotter, and on the right side you see our net futures position, which is 0, as the straddle delta and the futures net each other. We let the next day flow in. This time the market is falling, so the opposite will happen. The calls that had gone into the money are now less in the money, their delta has decreased. The puts are a little bit closer to their strikes, so their delta increased. On total, the straddles now make us only 21% short the market. We therefore need to sell some of the futures contracts we had bought before. On total, we have to sell 7 contracts, such that, once again, we have a perfectly hedged portfolio. A new day begins. This time the market is going up. That means I am going to buy futures again, on total 14 contracts. Next day, the market is moving down. That means I need to sell some of our futures contracts. On total, I'm selling 13 contracts. We can now let this process run for a few days, so that until month end, the following trade plotter is built up. Okay, what is this telling me? Well, we can see that every time the market went up, we had to buy futures, and every time the market went down, we had to sell futures. This trade plotter is showing us 2 things. First, it lists the history of all transactions that we need to compute our P&L. We'll come back to that. And second and decisively, no risk. For no single day of the month did we carry any overnight market risks. The net delta position of our portfolio was always hedged to zero. But why go through all this hassle? This can only be answered by computing the profit and loss that this process produced. To do that, I have to compute the P&L we made by selling the straddle and the P&L we made in our hedge portfolio. And this is precisely what we will do over here. The first part of this analysis is trivial. We have to look at the value change we incurred in the straddle position. We sold the straddle for 141 and at expiry it was worth 95. Why 95? Well, the call actually went into the money and expired with an intrinsic value of 95. The put expired worthless. As we sold 100 straddles, we are earning 100 times the difference of 141 to 95, which is 46 per straddle, or 4,600 euro on total. We can now relate this result to the nominal capital at work, and I assume this was 100 times one straddle strike, which means 100 times 2,325, which yields a profit of 1.97%. Perfect. We have done the first half. Now we have to compute the P&L of our futures portfolio. For that, we have to multiply the futures position that we carried from one day to another with the price change realized during that one-day period. We do this on a day-by-day basis, and we also show the cumulative performance of this process. And we see that during the month of June, the hedge portfolio produced a loss of 3,467 euros, which corresponds to 1.48%. All that is left to do now is to add up both results. 1.97 gain on the straddle minus 1.48 loss on the hedge makes a net result of 0.49% or 1,133 euros. Well, so far so good. However, in my experience, this sort of computation is the wrong approach to actually grasp the economics of the volatility risk premium. It's much more helpful to analyze how implied and realized volatility relate to each other. Remember, we sold volatility at 26%, but what was the volatility that we realized in our hedge portfolio? What we actually did was to replicate the return path of these two options, but not with some theoretical implied volatility, but rather by using the true realized market volatility, the volatility that materialized through the futures transactions of our hedge portfolio. We therefore recall our trade plotter and compute the volatility of the futures transactions recorded in this plotter. The formula that you see might look a bit complex, but it's really still basic statistics. All we must do is to compute the returns observed from one day to the next, and then we calculate their standard deviation, which we multiply with an annualization factor to obtain the usually quoted volatility per annum. As you can see, the realized volatility of our hedge portfolio was in fact 23%. Interesting. We sold 26% volatility and we realized 23% on our hedge. That is the volatility we were long. Okay, selling at 26 and buying back at 23, that sounds like earning money. It's as simple as that. Let's look at it another way. Let's assume we had sold those two options not with an implied vol of 26%, but with the actual realized volatility of 23%. Then would have realized 128 euro of premium income. 141 minus 128 equals 13. 13 times 100 is 1,300. And that is really close to the true profit we realized. This result is no coincidence. It is in fact so that on average, implied volatility trades more or less 3 points above the realized volatility. And this phenomenon cannot be explained by option buyers being ignorant or thoughtless, neither by option sellers being the smartest in capital markets. It's simply because by selling options, by providing optionality to capital markets, you actually position yourself as an insurance provider in the capital market. That means you are delivering a service to others, you are providing an utility, and clearly this service ought to be rewarded. I do in fact not know of any insurance market in this world where the premium you pay for the insurance coverage is less than what the insurance provider expects to pay out in terms of damage regulation. And that's also how the insurance business in capital markets works. Those who sell volatility are remunerated by an implied volatility which on average and over time trades slightly higher than the realized volatility. However, as in any insurance business, every now and then it becomes a very unpleasant and uncomfortable experience to be an insurance provider. The worst of all these phases was the Lehman crisis of 2008, at least in the history of the last 20 years. And that's why I will now take you to a closer look at this phase.